A very important concept to master, to look into, to include into your trading arsenal, to backtest and really see how it works for you is the flip concept, right? So we haven't really dedicated a specific lecture about the flip. I have numerous times broken it down during webinars, during different calls. I have also shared it in a couple of charts on Discord, but there is not a lecture that really explains what it is, how it works, how does it also differentiate from TC, right? So this video is specifically aimed to actually clear all the confusion about the TC, the flip, and how we can utilize it. I'm also going to share some little findings that I have about the flip. And then your task is actually going to be to go into the charts, to find examples, and to really see how it actually works, okay? So let's start by actually differentiating between flip and TC, because I think this is the hardest thing to do. I really hope you're all aware what TC is. We covered this one in the TFW module. It is a trend change. A lot of people call it Choch, Koch, CH. I don't care, right? This is the last break of the last higher low. I mean the break of the last higher low in an uptrend and the break of the last lower high in a downtrend. So if I just quickly draw a little downtrend, where is our major lower high? It's this one. Why? Because this lower high caused the break of structure. So if the market closes above this structure right there, this is a TC, which indicates that potentially we are about to change the trend, to reverse, okay? And of course, as explained in the TFW module, we would like to pair this one from hard time frame supply and demand areas and from areas of value above 50% with the trend and so on, okay? But let's focus more on the technicals. So yeah, I want to start with a little theory actually first. Again, in the TFW module, we learned that market structure is the foundation of everything. But if we ask one more question, what actually makes market structure? Well, it's supply and demand. It's simply the law of supply and demand. If something is increasing in value, there is more demand. A lot of people want it. A lot of people are buying it. So it actually increases in volume, in price, because the supply also decreases. Okay. As it reaches a specific price, right? Price level, potentially there are not a lot of buyers interested anymore because it's becoming expensive, and then you see the price actually starting to fail, right? And this is when we actually have supply introduced and the market turns from an uptrend to a downtrend. This is pretty much the demand to supply flip, all right? It's the exchange from demand market to supply market. Then of course, as the price is very big, supply gets introduced. Not a lot of people are buying the currency. They start selling it actually, or investing in different currencies, which leaves a lot of euros, for example, on the table, and then their price depreciates down until it actually gets attractive for investors so they can actually jump in again, right? So again, in enough theory, every single structural point forms supply and demand, especially the major ones. Okay, so if you look at this example, this push created a new higher high. So on the higher low, right, we know that it's a higher low, but it has demand inside. It has orders, because from this point, there were a lot of buyers that were interested from this price, so they actually bought and they pushed the market higher. Then we pull back. This is why we pull back, in order to get a better price to initiate higher again, right? But there comes a point, usually when the market actually taps into a big supply on the left, usually the price becomes a little bit expensive and we have a reversal, okay? So the reversal can appear in numerous ways, and usually we can have it like this, okay? So TC, what is a TC? If we mark all the demand levels that lead to this hard time frame supply on the left, the last one, when it gets broken, we have a TC, okay? But what is the detail about this one is that it just breaks it straightforward, right? There is no interaction, there is nothing, right? We just make a new higher high and all of a sudden, boom, we have a new low, right? There is no interaction whatsoever with anything on the left, okay? So what this does, it actually leaves you with an extreme OB, which is pretty much the OB that caused the break of structure. We also call it the extreme. So usually this is where you would like to take a trade from, the extreme, okay? Because there was no interaction from the last demand. Now, let's transfer onto the flip. So what is the difference right here is that, again, we have an uptrend, demand is being respected, there is the last higher high, the market pulls back right there to create a potential higher low, and this is still higher low, we're longing from here, right? But then the market tries to push higher, it fails, and then it actually smashes to the downside, which creates a flip. A TC and a flip can exist at the same time, right? Because this is a flip, but it's also TC. Why? Because it broke the last major higher low. Again, we learned how to mark higher lows. There is the uptrend. There is the uptrend right there. So this is the last push. This is the leg that we trade in. So this, for example, was minor structure at the time. But then as we break the major, which is right there, we also have a TC, but it's also supported by a flip. Why? Because we had a reaction from here. So what you're going to see with the flips is that the last demand is going to get respected. It's going to react. Maybe it's going to create another push into the highs and then smash to the downside. What this does, it introduces new supply, because right now, if we ask ourselves, what is the supply that broke demand? Well, it's this one. It's the last buy to sell also, okay? Now, the tricky part about this one is that oftentimes you're going to have an extreme OB on top as well, okay? And what could happen sometimes, a lot of times what I do is I trade both of them. So on numerous webinars I have said, if you have a middle OB, which is usually a flip, and if you have an extreme one, you have two options. You either play both or you only play the extreme, okay? You don't want to play only the flip and then don't take the extreme, because then the extreme is actually going to play out and you're going to end up with a loss, okay? So plan for this in advance. Usually if the flip is good, also another detail that I can mention right there is that sometimes the flip is also going to create a liquidity grab. So let's say you have first a reaction, then the market goes in again into the demand and actually creates a new buy and then a new sell-off. So what you have right here is a little liquidity grab right there with this buy to sell. So this even makes it a bigger probability for the market to respect this flip zone. But sometimes what can also happen is the market can actually try to respond, push a little bit lower, and then if it fails to make a new lower low, right, it's gonna come into the extreme and and this one is going to become liquidity right there. And I have shared numerous examples on this one on the webinars, so make sure you're actually checking them out. So those are the two types of flips that can actually play. You can either just have a straight flush, and if the flush doesn't happen, then it becomes liquidity. The flip zone becomes liquidity for mitigation of the extreme, okay? But again, the main difference, a TC just appears like this, boom, no pause, just breaks through the last higher low, while a flip has an interaction, right? The key word is interaction from the last demand, okay? So hopefully this makes sense, okay? Hopefully this makes sense. I'm going to try to pair it with some charts. So I'm just going to jump on my charts right now. And I'm going to freestyle it. I hope it's not going to take a lot of time, because this one is, if you don't have any specific charts that I can of course share with you in a different video, it's a bit too hard to find because it appears on every time frame, especially the lower ones, and especially like the detail with the fake interaction, it's a bit hard to find. So if you just follow the structure right there, yeah, usually we would also love to pair it with the higher time frames, which is gonna immediately increase the probability, right? We have push, higher high, higher low, higher high, higher low, higher high, higher low, higher high right there. So if you just keep marking the demand, there is the last demand respected. It made a new higher high. And then as you can see, then what actually caused that new higher high? It's this guy right there. So do we have a flip right there? Nope, we just have a TC. Why? Because we just straight smashed through this last demand right there. And why is this the last demand? Because it is the one that actually caused the break of structure, right? And right now we are utilizing wicks, so it could be a little bit, yeah, not very fair. But what we see happen later is that the market actually comes inside the extreme. And if we drop to like a lower time frame, you can have, of course, something in the middle right here, but it actually goes all the way up. If I actually refine it all the way to this candle, you can see this is where we actually tapped, okay? Now let me try maybe to find a different example. There was a short up there. Yeah, this is not very good, but this is again on the 15-minute, right? So let's say we're bearish, right? So what happens right there is we push, we create a pullback. So why is this a pullback? Because this bearish candle right there traded, did not make a new higher high, right? So it's also an inside bar, and then it pushed and made a new higher high. Okay, so this right now is our major higher low. It got broken without any interaction. Okay, so what this means is that we're gonna attack potentially the extreme. And if I drop to a lower time frame, oops, you're going to see that it actually went all the way up before it actually reversed. Okay, and you can also see it right here. It could be debatable. Let's try to examine it. Hopefully there is also an example of a liquidity grab flip. No, this is actually perfect, Because what we see right there is that this is the push that made the higher high, cool. Then we pull back, we created a higher low, cool. Then this is the higher high, okay? So what is our last demand? It's this one. So what happened with this demand? It just got smacked, right? We tapped for a little right there, and then the next candle was already a TC, right? There is no flip. If we have something like this right there, a push into the highs, and then a drop, then of course we can trade from a level like that. But this one just broke it with a body close below. So if we have this, we take the extreme, right? And if I refine it, you can see that once again, we retested the extreme, okay? So this is not a good example of how actually a flip plays. Can I find a flip? Do I have any journals right there? Let me try to pull in some journals right there. So see if we have actually any flips. Let's see what we have right here. Yeah, this is a flip right there. So yeah, this is a perfect flip. So this example is not the best, right? But let's say we're in an uptrend. This is a 50-minute OB right there. We are having an uptrend. Okay, so this is the 1 minute. Push, pull back, higher low, higher high. Higher low, demand is respected. See how I'm always marking my demand levels right there? Push, this is a new higher high right there. So where is my major demand? It's this last sale candle before the buy. The market comes in, taps inside. So it doesn't precisely tap into the sale candle, but this is more or less a range, right? And pretty much if you actually utilize the way that we draw OBs, it's actually the engulfed candle. So the engulfed candle is actually this one, right? Because this is the engulfing candle that caused the break. This candle was not engulfed, okay? But have a look. We did not straight from the top flush to cause a TC, right? No, we pulled back first. We tried to create a new higher high. We created this big bullish candle first, and then we flipped, okay? So this is a flip. This is a good example of flip. Okay, so what I wanted to do here is to enter actually from 50% of this buy to sell, but the market just respected the 25% and then it melted. Okay, there is another example of a flip, which is not so nice, but this was the last kind of major lower high. The market comes inside, respects, all right, it did not just break through it to cause a TC, it respected, tried to put up a new low, and then it failed and it flipped. So right now this turns into a flip, and if we have a flip, I told you that you're going to have an extreme at the bottom and you're going to have a middle OB, right? So what happened in this case is the middle OB got respected and we started going higher. Okay, hopefully it starts to make sense. Let me see if I have anything else. Yeah, this one was the trade that I actually showed you, which actually did not have a flip. Okay, so pretty much right there, as you can see, as I showed you right there, we had a TC from here. So the original entry should have been here, but I didn't take it from there. That I wanted to enter from a flip zone right there. You can see push, higher high, higher low. Then the market started responding. So what I was waiting for is for us to actually cause the flip and then to enter from there. But I just ended up entering from here. Why? Because we already had the flip on the left, right? So waiting for another one can sometimes cause you to miss a trade. This is a flip zone on the 15-minute. So let me show you. Just going through some trades right there with you. Where is it? Yeah, so it's not the best, but again, we have supply right there, right? You can, of course, you can debate with me right now that the actual supply is right there, right? But many times it can just be any supply that you actually see a reaction from and sharp momentum exiting outside, right? So I had this supply, the market tapped, responded, and then massive momentum into the highs. So this right now is called a flip zone. This is where we actually flip because there was an interaction. Sellers came in and then the buyers actually stepped in, right? There is another one. Yeah, is it? Yeah, there it is. So this one is both a TC and a flip, because if we again ask, okay, where is our last lower high? I would personally take this wick. I really like this wick. And yes, what we can see right there is that the market created this big push to the downside, pulled back, slowed down for a little bit right there, but then we actually tapped into the supply, and what we did, respected, rejected, liquidity grabbed, right? So this candle also took some sort of liquidity, which is another confluence, and then we very sharply imposed outside. So what you have right now is, again, an extreme and a middle OB, which is the flip, okay? But if on this case, we just had a push into the highs, right? There's no interaction from there, like this, then I would have taken the extreme. But on this occasion, we paired the flip with the Asian range, tap inside, and as you can see at the end, we actually ended up rolling up, okay? Do I have any other examples? I think I skipped one right there. Yeah, we can jump on the 1 minute to see if we can actually see a flip on the one. No, this is a TC. So this is a good example of a TC. So as you can see, we're looking for an entry right there. Lower low, lower high, lower low, lower high, lower low, boom, TC. So no flip right there. So if we have a tap, response, and then a push, then we would have had a flip, but no, this is just a straight TC. So what you would like to do on this occasion is, of course, play the extreme or just play the sell to buy range. And on this occasion, we had a 25 to almost 50% retest of the sell to buy range, right? Do we have other flips? Not really. No, this is again a TC right there. So you can see this is the last lower high, just TC. So we just play the extreme. That's easy. And yeah, nothing more. So I'm gonna stop right here. I'm not gonna try to search for any examples. I'm gonna give my best to actually share some more examples with you so that you can actually yeah, there is another one why you should actually play the extreme. Because if we follow up, so this is the huge push to the downside, but if we really ask, okay, where is the last lower high, where is the last supply? Well, personally, I'm immediately looking for the last buy candle before the push lower. Well, it's this one. This one just got disrespected, right? It just got broken with the wick immediately. Then, of course, you can say, okay, well, I'm going to take this one. This one also got respected immediately. So there was no interaction at all with any supply on the left. But still, we caused the TC right there. This one as well. And even if you take the top, also the top TC, right? We had a little reaction right here, of course. If you take this as your supply, which is according to me a little bit invalid because we have all of those levels on the left, there is a reaction and then there is this push, right? So on this point, you would like to play the flip. But as I build the story from the downside right there, actually it was the extreme that wanted to get respected. And sometimes, again, if you have a middle low bit like this and an extreme, play both of them. So if you decide, take it from there, stop loss below, get stopped, right? But then play the extreme because you can see later that the extreme really, really went. Okay. Do we have any examples? Yeah, this is a good flip that I took. It was actually a loss. So let's have a look. So we have a push, we have a higher low, then we have a beautiful higher high that was immediately kind of met with a very nice V shape. So if this right there is my last higher low, right, I took the whole range like this, which again, could have avoided the trade if I was a bit more perfect, because you can see that this is the zone. We actually did not tap in the zone and react, but I just took the whole range because I always like to have this reaction. So you have a push, pullback, higher low potentially, responded, actually went to probably tap inside this little zone right there, and then it flipped very massively. Okay, you can see we had a little response from right there, right? But this response is very minor. If we had one more candle right here to actually take liquidity above this high, then I might play it. But in this moment, this becomes liquidity right there. And as you can see, we came inside, tried to respond, and failed. Okay. Do we have anything else? Not really. This is a TC right there. No, we just continue and then we just melt. Okay, so I'm gonna end it right there. Hopefully, where is my concept? Okay, I probably deleted it. No, it was on the other chart. Hopefully it actually makes sense, right? The difference between flip and the TC. Your task right now is to actually go and backtest it, see how it works for you. Try to find numerous examples. Please send them to me via Discord so I can check them out for you and we can gather, for example, a big case study, a big trade magazine with all of those flips so that we can actually have a lot of visual representation of them. Okay, so hopefully this was helpful. Let me know if you have any questions, and yeah, hopefully you can implement the flip concept.